A hidden operating system runs the world, controlling everything from energy prices to global government policy. It is known as the petrodollar. To understand how this system works, look at the one resource modern society cannot survive without: oil. We use it to transport food, power our electrical grids, and manufacture almost everything. Flashback to the aftermath of World War II. While the industrialized world lay in ruins, the United States emerged with its economy and manufacturing base entirely intact. In 1944, delegates from 44 nations met at Bretton Woods to establish a new financial order. They built a consensus to place the U.S. dollar at the center of global trade. Foreign nations tied their currencies to American money because the U.S. promised that dollars could be exchanged for gold. The post-war global economic order relied on this mechanism, with stability anchored to the physical promise of American gold. That guarantee evaporated in 1971. Facing pressure, President Richard Nixon unilaterally severed the U.S. dollar's tie to gold. This transitioned the world to a fiat currency system, government-issued money that is not backed by a physical commodity. Its value comes strictly from public trust and the perceived stability of the U.S. economy. 2 years later, the system fractured. Arab oil-producing countries imposed an embargo to retaliate against Washington's military support for Israel. The domestic impact was immediate. Oil prices quadrupled, triggering high inflation and severe fuel rationing across the West. The United States was suddenly defending a currency backed only by trust, while its economy faced literal energy starvation. Washington formulated a strategic response. They approached Saudi Arabia, the single largest oil producer on the planet, to negotiate a trade. The two nations had complementary vulnerabilities. Saudi Arabia had massive oil wealth, but required defense. The U.S. offered to provide military protection and hardware for the Saudi kingdom. In exchange for that protection, the U.S. required that Saudi Arabia mandate all of its oil be purchased exclusively using U.S. dollars. As the most influential member of the OPEC cartel, Saudi Arabia's decision established the standard for the entire region. Since the world's primary energy export market was now priced in dollars, other producers followed suit to maintain market access. This boardroom trade transitioned the U.S. dollar from a currency backed by physical gold to one functionally backed by global energy. Consider the logistical reality for a nation like Japan. They lack domestic energy. To buy the oil needed to power their cities, they are now forced to constantly acquire and hold massive reserves of U.S. dollars. This dynamic creates constant international demand. As oil flows globally, a river of dollars flows steadily into the Middle East. Nations manage these surpluses through petrodollar recycling, investing directly back into the American economy by purchasing U.S. bonds, stocks, and real estate. This loop of forced demand and automatic reinvestment stabilized the fiat dollar. It provides the U.S. Treasury with a constant source of liquidity, effectively anchoring the currency to the global energy trade. The recycling loop allows the U.S. government to borrow money and issue debt at lower interest rates because the global demand for the dollar remains constant. Since every country needs dollars to buy energy, almost all significant global trade eventually routes through U.S.-regulated banks. Washington utilizes this system to enforce financial sanctions. By cutting off access to dollar clearing systems, the U.S. can isolate hostile nations from the global economy. The 1973 strategy evolved into a structural advantage. By controlling the primary currency of global energy, the United States gained the ability to monitor and restrict the financial lifeblood of other nations. Today, that dominance faces a coordinated challenge. The BRICS trade alliance is actively developing methods to bypass the U.S. banking system entirely. Russia and China are already executing oil contracts in non-dollar currencies, testing alternative payment models to reduce their reliance on the dollar. However, abandoning this system is difficult. It requires the disruption of global hedging systems, established insurance models, and long-term pricing contracts that have been in place for decades. The U.S. dollar still offers the highest market liquidity and established legal protections, which prevents the sudden price volatility found in smaller currencies. While competing nations are selectively reducing their dollar use, the petrodollar system remains a deeply entrenched financial loop that continues to dictate the mechanics of global power.